$300 million worth of Bitcoin shorts got liquidated in a single day. 108 million of that happened in 1 hour. 1 hour. The people betting against Bitcoin just got absolutely steamrolled, and most retail investors missed the entire thing. Welcome to the Bitcoin Report. I'm AI Ryan Matta. The real Ryan put this script together this morning before his day got away from him, so he handed it off to me to deliver. That's the deal here. He does the research, I do the talking. What we're covering today is the $80,000 breakout that just happened, why it was built entirely on institutional money while retail sat on the sidelines scared, and what it actually signals for Bitcoin holders right now. This one matters. Stick with it. Let's set the scene. Bitcoin has been grinding around in the 70,000s for months. Every time it tried to reclaim $80,000, something knocked it back. Bears were piling in short. Retail sentiment was sitting in fear territory. The fear and greed index was at 26 out of 100. Most people watching crypto on social media were calling for more downside. And then in the last 48 hours, everything shifted. Bitcoin broke above $80,000 in early Asian trading hours on May 4th and hit a high of $80,050. As of right now, May 5th, it's trading at $80,894. That's the highest price Bitcoin has seen since late January 2026. And the way it got there is the story. This was not a retail-driven pump. This was not a meme coin cycle spilling over into Bitcoin. This was institutions quietly accumulating through ETFs all of April, setting a trap that retail shorts walked straight into. And when the price cracked $80,000, those short positions started getting forcibly closed, which pushed the price higher, which forced more shorts to close, which pushed the price higher again. That's a short squeeze. And $303 million worth of it happened in 24 hours. Let's break down exactly what happened, layer by layer. The first layer is the ETF story because that's the foundation of everything else. In April 2026, US spot Bitcoin ETFs pulled in $197 billion net inflows. That's the strongest institutional month since October 2025. And that money was coming in quietly, steadily, while most retail investors were sitting on their hands. BlackRock's IBIT alone now holds approximately 812,000 Bitcoin, worth around $62 billion. That's 62% of the entire Bitcoin ETF market, controlled by one product. Cumulative net inflows into US spot Bitcoin ETFs since they launched in January 2024 now sit at $58.5 billion. Total. That number is staggering when you actually sit with it. Here's why the ETF inflow number matters so much. Bitcoin miners produce around 450 new coins per day after last year's halving. That's it. That's the total new supply entering the market every single day. When $197 billion flows into ETFs over a month, the ETF providers have to go buy actual Bitcoin on the open market to back those shares. That daily buying from ETFs is dramatically outpacing what miners are producing. You cannot sustain that kind of supply pressure without price eventually responding. And that's exactly what happened. The second layer is the whale accumulation that was happening underneath the surface. While retail investors were in fear, wallets holding 1,000 or more Bitcoin were growing. These are people and entities with real money, and they were buying. On-chain data from around this period shows roughly $1.2 billion worth of Bitcoin was pulled off exchanges in a 24-hour window. That's important because when people move Bitcoin off exchanges, it means they're putting it into cold storage or self-custody. They're not planning to sell. They're not keeping it on an exchange ready to liquidate at the next dip. They're hoarding it. That's the signal that a market is tightening from the ground up. And then the geopolitical catalyst hit. Trump announced what he's calling Project Freedom, a U.S. military operation to escort commercial ships through the Strait of Hormuz, which had been a flashpoint for oil price volatility. Brent crude, which had spiked as high as $126 the week before, pulled back toward $107 on the news. Risk on sentiment returned across markets, and Bitcoin, already coiled tight by months of institutional accumulation, exploded through $80,000. There was a brief moment of chaos on May 4th when Iran's state news agency claimed 2 missiles had hit a U.S. warship. Bitcoin dropped back to around $79,000 on that headline. Oil spiked 5% in minutes. Then the US denied the report, the story fell apart, and Bitcoin climbed back above $80,000. Asian trading hours pushed it to $85.29 and then $81,000. The bears had already been liquidated at that point. The worst damage was done. Now let's talk about what the $80,000 level actually means structurally, because this is more than just a round number. Analysts track something called the bull market support band. It's a moving average zone on the chart that Bitcoin has historically used as support during uptrends and failed to hold during downtrends. When Bitcoin loses that band, the market typically gets ugly. When it reclaims it, the structure shifts back to bullish. Bitcoin had not been trading above its bull market support band since November 2025. 4 separate recovery attempts failed to push through it. On this run, Bitcoin reclaimed the band. For chart watchers, that's a structural shift, not just a price milestone. The next resistance level analysts are watching is $86,000. A clean hold above $80,000 and a push toward $86,000 would bring $90,000 and $100,000 back into serious conversation. The risk on the other side is that if leverage long positions start unwinding, or if macro conditions shift sharply, the price could get pulled back into the 70,000s. That's the honest version of where things stand. But here's the detail that changes how you should think about this rally. Most people, when they see Bitcoin go up fast, assume it's retail buyers getting excited and piling in. That's how it used to work in earlier cycles. This time, data from CryptoQuant shows that Bitcoin's April rally from $66,000 to $79,000 was driven almost entirely by perpetual futures demand, not spot buying. Spot buying actually contracted during that period. That's a nuanced but critical distinction. Perpetual futures are contracts where traders bet on Bitcoin's price without actually buying the underlying asset. When futures demand outpaces spot buying, it can create a fragile rally because the price is moving on leverage, not on actual Bitcoin being purchased and held. Analyst Ali Martinez flagged this concern, pointing out that stablecoin reserves on exchanges dropped from around $70 billion to $66 billion during the same period. Stablecoin reserves are essentially dry powder, money sitting on exchanges ready to be deployed into Bitcoin. When they drop, it can signal capital is leaving the crypto ecosystem rather than rotating into Bitcoin. He called the rally structurally fragile. That's the bear case, and it's worth knowing. The honest read on this moment is that the move to $80,000 had institutional fingerprints all over it, but the spot buying data underneath it was not as strong as the price action suggested. The next few weeks of ETF flow data will tell us whether this is the beginning of a sustained leg up or a move that needs to consolidate before continuing. What is not uncertain is the macro backdrop that Bitcoin is sitting in right now, and this is where the story gets really interesting for long-term holders. The Federal Reserve held rates steady at 3.5% to 3.75% this week. Jerome Powell's term as Fed chair ends on May 15th. Kevin Warsh is expected to chair the June FOMC meeting, and Warsh has historically leaned toward tighter monetary policy. That creates a window of uncertainty for risk assets. But here's the flip side of that. There is roughly $4.1 trillion in U.S. government debt maturing in 2026 alone. The Treasury has to refinance that debt, which means issuing new bonds, which means the government needs buyers. At some point, the pressure to keep borrowing costs manageable points toward more monetary easing, not less. Bitcoin as a fixed supply asset that nobody can print more of benefits structurally from that kind of monetary environment. Now let's talk about the two biggest catalysts sitting just ahead of us, because this is the context every Bitcoin holder needs to understand right now. The first one is the Strategic Bitcoin Reserve. At the Bitcoin 2026 conference, White House advisor Patrick Witt told the room that a major announcement on the Strategic Bitcoin Reserve is coming within the next few weeks. The background on this is that an executive order already exists directing the Treasury to hold seized Bitcoin as a strategic asset. There is draft legislation called the American Reserves Modernization Act, or ARMA, which proposes the U.S. government accumulate up to 1 million Bitcoin. 1 million Bitcoin. The U.S. currently holds seized Bitcoin, meaning coins confiscated from criminals and hackers. It has not yet started buying Bitcoin on the open market. If that changes, the supply math becomes almost incomprehensible. Kathy Wood from ARK Invest put it plainly when she said that if the US moves from holding seized Bitcoin to actively buying Bitcoin, it would trigger the scarcity event that long-term holders have been anticipating. Nearly 20 million of Bitcoin's 21 million coins have already been mined. There's not a lot left to find. The second major catalyst is the Clarity Act. Senator Cynthia Lummis confirmed that the Digital Asset Market Clarity Act is heading for a Senate Banking Committee markup in May 2026. A markup is the step where lawmakers debate and amend a bill before it moves to a full Senate vote. This bill has already passed the House. The Clarity Act would define which U.S. agency oversees digital assets, ending years of regulatory uncertainty that has kept large institutional investors, pension funds, and major banks from fully entering the Bitcoin market. Right now, an estimated 99% of institutional capital cannot access Bitcoin or Bitcoin ETFs due to mandate restrictions in their investment agreements. Regulatory clarity would begin to unlock that capital. The market's immediate reaction to the Clarity Act news has been muted because investors want to see concrete passage, not just committee activity. But the direction is clear. Both of these developments are pointing the same direction. Sovereign adoption and regulatory clarity arriving at roughly the same time as a supply squeeze from ETF buying is a combination that long-term Bitcoin holders have been building toward for years. Zoom all the way out for a second. ARK Invest released a report projecting Bitcoin's market cap will reach $16 trillion by 2030. That's a more than tenfold increase from today's roughly $1.6 trillion. Their thesis is built on three legs: continued ETF inflows creating a structural demand floor, corporate treasuries following strategy's playbook and adding Bitcoin to balance sheets, and sovereign entities beginning to hold Bitcoin as a reserve asset. If even one of those three legs comes in stronger than expected, the math changes dramatically. The supply story on its own is already extraordinary. Bitcoin's circulating supply is now 20.02 million coins out of a hard cap of 21 million. There are fewer than 1 million Bitcoin left to be mined, and the halving cycle means miners are producing less than half of what they were producing 2 years ago. Every single day, ETFs are buying more Bitcoin than miners are producing. Every coin that moves off an exchange into cold storage is a coin that's not available for sale. The setup is exactly what long-term holders have been waiting for. Peter Brandt, a veteran commodities trader with nearly 5 decades of experience, is calling for a potential Bitcoin bottom in September or October 2026, followed by a move to $250,000 in late 2029, anchored to the 4-year halving cycle. That's a more cautious timeline than some analysts, but it comes from someone who has been tracking commodity cycles since the 1970s and has a track record that earns him credibility in this space. His view is not that the story is over. His view is that the next chapter plays out over the next 3 years, not the next 3 months. The big institutional players know this. A joint report from Coinbase Institutional and Glassnode found that 75% of institutional investors and 71% of retail investors currently rate Bitcoin as undervalued, both groups. In a fear environment, that's a remarkable level of consensus between sophisticated capital and ordinary holders. They're looking at the same supply math and arriving at the same conclusion. At Bitcoin 2026, a panel on the Nakamoto stage made a point that stuck. There are only a few hundred companies in the world currently holding Bitcoin on their balance sheets. Strategy essentially blazed that trail alone, and others are slowly following. The window to be genuinely early in the corporate adoption cycle is narrowing. Institutional infrastructure, custody solutions, compliant products, regulatory frameworks, all of it is being built right now. And once it's built, the next wave of capital doesn't trickle in. It comes fast. The short squeeze that just happened is a small preview of that dynamic. When Bitcoin supply tightens and demand spikes suddenly, the people positioned on the wrong side don't get a slow, graceful exit. They get liquidated in an hour. The holders win. The people who understood the supply math moved coins off exchanges and stopped trying to time short-term trades. They win. That's not a prediction. That's the pattern that has played out every single cycle, and the structural conditions right now are more aligned with that outcome than at any point in Bitcoin's history. If you're getting value from this kind of daily breakdown, subscribe to the channel. We do this every day. Real numbers, real context, no noise. And go to bitcoinmaxing.com. The real Ryan built a free Bitcoin retirement calculator over there. You put in how much Bitcoin you hold, your timeline, and it shows you potential scenarios based on different price projections. It takes about 2 minutes and it puts your stack in a completely different perspective. bitcoinmaxing.com. Free tool worth your time. See you tomorrow.